Hello and welcome to the market update here for Tuesday, June the 13th. Any questions, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. As far as the direction alerts, well, obviously we know we broke above that key area of resistance. I talked about this last week. If you want more details on that resistance, I'll bring it up again here in a second when we get to the charts, so you can kind of see this area, and we'll look at the next area that we would focus on. We also want to keep an eye on how far this run has gotten. Is it getting stretched? Is it getting a little bit overbought? A lot of times when I talk about wanting to see how things correct before I get in, if we get a impulsive up, impulsive down, it could signal a reversal. If we get a pullback that's more kind of choppy, corrective, it would be more bullish. So if you're trying to get an idea of, well, does this mean that we're now taking off the upside, or is there still risk for downside? I think a lot of that's going to be determined by how we pull back when we do pull back. We also want to still keep an eye on those big cap tech stocks. I talked about how they've been holding the market up. We're still seeing breadth on the light side. I'll be interested to see when that indicator updates tonight, if that breadth has picked up a little bit, and this is, and we'll look at the breadth indicator in just a second here too. But that's something that is concerning me a little bit. And then a little bit of the movement of the VIX over the last couple of days is something that I'm keeping an eye on as well. So as far as, let's start off with our direction alerts. Momentum is moving into that extreme reversal risk range, although it still can move a little bit further to the right side. Although, remember, it's not taking into account today's move. So that'll definitely push it a little bit further to the right. We are getting a little bit stretched to the upside, and we've been aware of that for a little while here. Now, markets can, especially if the buying really gets crazy, it can stay overbought for a while. So again, I really caution you on this, that you're not looking at this alone as, hey, this market's going to pull back right now or immediately. It's all it's telling you is that it's stretched. When is that rubber band going to snap? That's always the question. It can stretch. Sometimes it can stretch even further than you think it can, and definitely, since everyone's been focused on this area and we're kind of breaking out of this area, I could see the market taking off a little bit here, because what it would probably do is attract some of those retail investors that have been on the sidelines. You start getting, the market starts making pretty decent moves, and you get headline things, especially related to the Fed meeting tomorrow. And, the average investor doesn't watch CNBC or financial news sites, but they do, watch the nightly news or read the daily news off their phones. And when you get these headlines of, markets up this amount and the bulls are charging again or something like that, it kind of triggers some of these retail traders that, hey, it's time to get back in. It could be another, 2020 when things really took off and all these SPACs came into play, and then remember, Bitcoin flying and all that kind of stuff, and that greed kind of kicks in. It can kind of attract some of those people that are on the sidelines. Now, that's usually a sign of the end of a move, when the kind of the quote unquote dumb money starts piling in. That's usually when the professional traders are selling to those people when things are about to drop, but that can last for a little while. And so that's something to monitor and watch. But keep an eye on, you start to see these big headlines, these big bullish headlines being flashed about, that's usually, again, a sign of the top, as you start to see that everyone's now talking about it. Now, one of the things that kind of concerned me a while back, as you remember, is that, we've been waiting kind of for the sell-off, but the part of the problem to the sell-off, and we saw it every time the market would start to reverse and start to sell off, is that I think there were just too many people that were bearish. Now, they weren't bearish in the sense that they were actively shorting or pushing the market lower, but they were definitely bearish to the point where when the market would rally, they weren't anxious to be joining the rally. And so what you saw was buying being muted, but we weren't going up, but we weren't dropping, and we got stuck in that sideways range for a long period of time. And it took a shift. We had to get more people, more bullish to alleviate that a little bit. And I think we're getting that here, where the market's definitely turned more bullish than it was, a couple months ago, even a month ago. It's turned a lot more bullish than it was even a month ago. So maybe the good thing about that, though, is it's going to create more emotion now in the market. I just want movement in the market. When it stagnates like that, it's so difficult to make money when it's just moving flat or sideways. And I think we'll start to see that now, whether it's movement to the upside or some sharper sell-offs as some of that dumb money starts chasing the move. You might see a few of those sharper sell-offs that take place. But momentum is stretched a little bit. Breadth, like I said, is still lagging. And there's been a lot of people that have been coming in lately and said, well, all those people that talked about the rally was just, 10 mega cap tech stocks. Well, that's not true anymore. It is more broad-based. And there is some truth to that. We can see it with the Russell 2000. I talked about this last week with the Russell 2000 rallying pretty strongly. Those couple of days there showed that there was more participation in the rally. But this indicator is still showing that there isn't as much participation as there should be. And now, again, either this means that there's not enough to hold the market up and it's going to reverse, or it means that that participation is going to start and catch up to those few mega cap tech stocks. I don't know which of those two is going to happen. Usually it tends to be that, that it fizzles, but like I said, nothing that is normal has been happening lately. None of the probable moves have been happening lately. And so I'm not locking into any sort of an outcome based off of history right now, with the way things have gone pretty much over the last 8 months or so. And it's almost like the market is taking every normal behavior and doing just the opposite of what it's done for the last 30 years or so. All right, so breadth is still lagging. We just want to make note of that. Pay attention to that. Sentiment is still really high. The buy-sell ratios are still not stretched. We could still, we're barely getting started here as far as widening this gap out. I mean, this isn't even really extreme right through here, where that was the sell side. Here's a buy side one where again it was stretched, but I wouldn't call that extreme, too extreme. And so there's some room to run as far as that's concerned. But then you take the sentiment indicator over here, and you're right up against that red line. You've already pushed above it a couple times. Now, these last couple of times we didn't get this one we got a pretty decent sell-off right here. This one wasn't pretty sharp. It was just really brief. And could it be that? Well, it's just going to be hard for the market to rally significantly when the sentiment's up, bumping up against it. We can see it going all the way back every time it gets up here. That's why I like this indicator. It really is a pretty accurate indicator. But this is just a reminder to be careful chasing the move here, because of where it is. It's elevated. Now, again, this is not immediate. It could become even more overbought as we've seen. It can get a little bit more extreme, but it's probably telling you that we're closer to the tail end of this initial move right here over the last few weeks. I'm just talking about that move, not the overall trend. Not that the overall trend off the October lows can't keep going higher. I'm not suggesting that, but just this latest breakout move is getting a little stretched. Probably need to get a pullback that brings us down a little bit further, that can allow it to rally a little bit longer before getting stretched again. So kind of need to see that move. And that's kind of what I'm waiting for, to get a little bit more aggressive in the portfolio before adding a few more things. I want to see how the pullback looks. Does it look more corrective? Does it alleviate that overbought condition? And this goes back to the momentum indicator as well. Like to see momentum back off a little bit on a pullback, get back into the buy range, near the hold range, somewhere in here. You can really you could really have a good run off of something like that, off of that condition at that point. All right, let's take a look at the chart. I'm going to back out to a 1-year chart here. So the area that we were really watching last week was this previous high right here. Let me back out to a 2-year chart because the context here. We broke above this. Now Friday we ran up to it and then we reversed. So there was still some, at least, and I'll zoom back in again, but in the price action on Friday, it looked like it still could reverse at this spot right here, the way it was behaving. Monday, we broke out. We closed at the highs of the day. It was a clear breakout above that area. And then today we've gone higher, although I want to see if does it fade a little bit into the close? Does it give us a little bit of a bearish reversal candle? That'll be something to watch. Now, the significance of this area is that it was also the 50% retracement of that entire move down. That was the halfway point right here. No, the 618 retracement. Meaning that if we got above this area, the probability of getting a bigger move down, a bigger drop, starts to diminish. It starts to become less likely. Now, it's still possible. You can have deep retracements. And again, this could be one of those things that we start talking about where we say the chance of getting that drop is becoming less likely. And what I just get done saying, this has been the year of the less likely move. Maybe it means that this is exactly what's happening. It's setting everything up to where it's going to look like it's unlikely we're going to test those October lows or get to those October lows, and then we reverse. In fact, I want to throw this out here. Something I was thinking about the other day, but I also want to point out that, again, I'm not trying to look for things just to fit my bias. I told you that if we start breaking above this area here, I am going to turn more bullish. That is an area where I understand those probabilities start to change. I want to try to be on the right side of those probabilities as much as I can, even though it's been hard lately with a lot of the lower probability moves taking place. But one thing I constantly do is game plan, meaning I look at possible things that could happen so I don't get caught off guard if they do. And if you remember a few weeks ago when we were testing this area right here, this was the significant area we were trying to break out of. Remember, that was that long sideways move we had right here. And I said, and this, we knew this was the key level where, the market could, we really had to start to shift, to turn more bullish because it was above that 618 retracement level. And I made a comment that I thought there was a possibility we could break out or look like start to break out. Everyone was focused on this area up here. And I thought maybe we'd get a reversal before we got there, meaning somewhere in the middle here where no one was expecting it. Everyone's expecting it to get up here, and then we have that sharper sell-off. Now, that didn't end up taking place, but I also didn't go and bet on that taking place. I traded some shorter term drops based off of bearish candles at the time and made a little bit of money, had a little bit of a winning streak with some options at the time. But it didn't reverse right there. And now this is the new area right here to look, the next target area to look at. Now, this one is not as significant in because of the fact that it's, we're beyond that, getting beyond that 618 retracement level. there's going to be, this will be, the people will talk about this, but it'll be less in focus than these other levels were. Because these were really the early levels that could tell us that maybe the market was going to start to trend up at that point. But if you're looking at almost a perfect spot for a reversal to take place in the middle somewhere, you got a stretch market that's breaking out. What if we do run up for a couple more days? That market becomes really overbought. It's fueled by sideline money chasing the move. The sentiment of the market turns more bullish than bearish. For a reversal to take place in the middle, this is almost a better setup than the one that I talked about back in here. Again, I'm not saying that that's going to happen, but if we keep running up in an overbought condition, and it just seems like, man, I can't believe we're going higher again tomorrow, then I will look for something like that to possibly take place. Again, it may just lead to just a pullback, just a correction of the trend. Maybe it comes back and retests the breakout and then takes off again. But I'll be looking to try to trade something like that if it keeps stretching right here. Try to trade a little bit of a pullback when it happens. If it happens to be a bigger one where it does get more panicky, then so be it. If it's more bullish where it's choppy on the way down, that's fine too, because you can make money on the way down, then you can set up for some nice bullish trades on the way up. But that's where I'm going to really start to look for. I'm turning more bullish right now, but that's where I'm going to start to look for more bullish trades, is when we pull back right here, because I want to see how we pull back, or maybe we pull back right here. I mean, I'm not saying it couldn't pull back and back below that breakout area, but I want to see how we pull back. Yeah, but that's the next target area all the way up here, about right around 460, somewhere in that area there. Let me zoom back in. You can see, so this was the move on Friday, and that trend line comes right through here. We got above it on Friday, and then we came back below it. And we were talking about how, and this is exactly what I was talking about last week. Last week I was saying on the S&P, I was saying, hey, the more this is moving sideways, the more likely it is that it's going to at least have another push higher. It could just push up just like it did right here. That could have been it out of that sideways move. But it has gone higher than that. But this is what I'm talking about, seeing how it pulls back. Now, this wasn't much of a correction, and it didn't really alleviate the overbought condition of the market very much. But this is an example, though, of what I would be looking for is if, so again, based off of the typical behavior of trends is you tend to alternate between impulsive and corrective moves. And when you reverse trend, very often you'll have an impulsive move in the opposite direction, impulsive up and then impulsive down. And then again, you'll start to alternate between impulsive and corrective moves again on the way down. And then when you get to a bottom, you'll have impulsive down, impulsive up, and then you'll start to go corrective. So I want to see how it pulls back from that high. I was maybe looking at it right here. How does it pull back? Well, it pulls back in more of a choppy kind of an ABC type fashion. Okay, well that's telling me the trend should be continuing upward, at least from a probability standpoint. If you get impulsive up, impulsive down, that could be a signal that a bigger correction is underway. Then what you like to look for is how does it correct the move down. If it's more choppy and sluggish, that could be setting up for a bearish trade coming down further. So in other words, if we start pulling back, let's say we pull back to the breakout area right here, and we kind of pull back and kind of a back and forth, have a choppy type fashion. It looks like it's starting to drop and it rallies back up a little bit. It's kind of more sideways. Then that's a bullish behavior. That means we're more likely to continue to be moving higher at that point. If it's an impulsive move down, it breaks back below that breakout area, and then maybe it rallies back up to it in kind of a corrective fashion. then it means that it could have another move down. Now, maybe it's just a larger ABC that forms, and then it's really ready to take off again. I'm not saying that that behavior would lead to a move all the way back down to October lows, but that's what I'm kind of looking for here. And this is why it's understanding. If you understand that the basic trend behavior, I call this stuff the kindergarten crap because it's so basic, and you draw this out like a first grader is during arts and crafts session, right? It looks like really basic stuff. Yeah, I get it. It's like everyone always says, yeah, I understand that. Let's get to the real stuff that's going to tell me what the market's going to do. But this format, understanding this behavior, that it alternates between impulsive and corrective moves. What direction are the impulsive moves in? Just something as simple as that. That tells you the stronger trend direction of the market are the stronger impulsive moves to the upside, or are they to the downside? But if you understand this stuff, then you understand not only how to recognize when trend reversals could be taking place. And again, it's never perfect, but if you get the basics down, it's a lot easier to recognize it. But also where to enter, where to take advantage of that trend direction. It's usually not when it's getting stretched. It's usually watching to see how it pulls back, and then that behavior of how it pulls back will tell you, hey, this thing is likely to keep going. And again, it doesn't always move perfectly like we think it will, but it does enough times to where it gives us that advantage and that edge that we need. We just need a slight edge over anyone else that can't read that or see that. Now, another thing I'm keeping an eye on is, we can take a look at the Dow here. The Dow is, we talked about possibility of this forming a bullish head and shoulders pattern. Here's your neckline. We're right up at the neckline right here. A break above that neckline would be bullish in the near term on the market. So for some of the Dow stocks, we can break out above here. That could continue. Now, again, it's a little stretched in the near term as well. All of these indexes, again, you look up here, they're getting to the right side of that extreme reversal risk. So even if it breaks above the neckline, you worry about, does it pull back immediately and retest it? But if it does, whether it goes a little bit further and then pulls back, whenever it pulls back, and especially if it's more choppy and corrective looking, that'd be a good signal that there should be that continued move higher at that point. But that pattern's looking a lot more bullish. Qs, now the Qs are there's a resistance area up here a little bit further from where we're at right now, right around that 373 area there. But so that's an area to watch. We backed off a little bit from the extreme reversal risk as some of those big cap tech stocks have kind of corrected a little bit, or look like they're correcting. But that's a target area to keep an eye on. And then the Russell 2000 is nearing it's already at a key resistance level. There's another one above it. But this is an area to watch right through here. It was support back in this area here. A little bit of resistance here, resistance here, resistance here, resistance here. A little bit of support in here. So we're back in there. Now, if it breaks above that, then you're immediately focusing on this area up here. And that's going to be key, because that would be the point where the Russell now is gone to a higher high. It hasn't gone to that higher high yet. The other indexes have. A move above here would kind of show that it's moving up the right side of the bull. And I always look for, if these lows hold right here, those would be higher lows from these lows down here. There's kind of a double bottom down here. And a breakout above here would give you you got the higher low, it would give us higher highs. So we'll continue to watch that, and that would, if this is a longer bullish move, that would confirm a larger bullish move if it continues to do that. All right, bonds. We're still kind of stuck in this range. We do want to make sure we focus. Let me go to a 1-year chart here. Focus on the range. We move below here, that'd be bearish for bonds. We move above here, that'd be bullish for bonds. We're still sideways in this mess. We've really gone just completely sideways for the last week. So, we're kind of just focused on that range, because that's the only significant move is when it breaks out of the range, up or down. That'll tell us whether bonds are now, because right now we're just in a sideways range. We're in a sideways trend. Ask me the trend of bonds, it's sideways. Till we break out of that range, upside would be more bullish for bonds, downside would be bearish for bonds. We'll see, wait until that happens. Gold has pulled back a little bit. It bothers me a little bit as it's pulled back today with the dollar actually dropping a little bit too, which is a little concerning. Now I get it. Gold's going to move higher. One of the tailwinds for gold going higher would be higher inflation. Obviously, inflation numbers are coming down, and so I think that the CPI report today was is probably the biggest reason why gold is down a little bit. I don't like, in the near term, I don't like the pattern, and I have a trade on this one, so I might end up getting stopped out. I decided, I'm close enough to my stop out point. There's no point to get out early. But the fact that we're kind of moving sideways here, and the previous move was down, we also had kind of an impulsive up, impulsive down type of behavior that went to a lower low. I mean, this is looking a little bit more bearish in the near term. Now, again, my long-term bullish outlook on gold. And remember what I said when I pointed that chart out, it's a long-term chart. So if you're trading a long-term chart, you're putting money in gold and then you're forgetting about it. And you're just assuming that over years and years that we're starting could be starting a really big uptrend in gold. But in the near term, it could be that we're just going into a larger ABC correction, that this is, we have this big run up right here, and that this could just be wave A. You're getting a congestion period right here for wave B, and then you get wave C down into here, and then it takes off again. So I wouldn't be adding any gold. And like I said, if I get stopped out, what I'd be looking for is, if we got down to this area here, and if inflation looks like it's maybe ticking back up again or something like that, or with the dollars dropping or falling significantly, that could be a little bit of a tailwind for gold to take off. I might consider another gold trade there. But excuse me. All right, but I think in the near term, it looks like it could have a little bit more downside based off of that chart. Oil's been really schizophrenic lately. It had the big move down yesterday, and then it's had a big rebound move up today. We're still in this sideways range, and I would do the kind of same thing as with bonds. If it can break out to the upside of that range, it'd be more bullish. If it breaks down to the downside, it'd be more bearish. The talk yesterday was that, the big drop in oil is the oil market telling us that it believes a recession is coming. This is why, you can't be trading off of headline news, though, because then so the big rebound today is telling us that now the oil market is saying there's going to be no recession. There's a lot of factors that go into the movement of the stuff. That's why I don't like to trade commodities, is you really have to just focus on trading commodities and learning all the nuances of what moves some of those. It's not just the price of the dollar or the movement of the dollar. And there's some things in the case of oil, you got a cartel controlling the prices, and so that's a whole other element to your trade that is out of your control. That it can make it trade off of, instead of supply and demand, just manipulation. But overall, again, you've got it's been just kind of trending down and kind of this choppy behavior. It's been kind of sideways, but it's kind of been trending down. I'd want to see it kind of break that pattern. In fact, now you can kind of draw trend line right through there, trend line right through here. And a break above that range would be a little bit more bullish. Break below here would be more bearish. Some of those individual oil charts look pretty chaotic as well. And there's enough of them that are trending pretty nicely to avoid charts that are trending erratically. Why give yourself the added aggravation when you can just go trade something that's acting more like it wants to move in a particular direction. The dollar, you can see, moved down a little bit today. I still think this is part of just a corrective move, a bullish ABC pattern. I think the dollar is still acting like it wants to go higher. You got this kind of cup with handle formation forming on it, which would be very bullish for the dollar as well in the near term. Now the VIX had an interesting move yesterday, where we were down below 1350. And then we closed right at 15 yesterday. So we had not a big spike up, but that was a pretty decent move in the VIX. And you remember, in the context, it was a move up in the VIX with the S&P breaking out above that key resistance area right there, right? Now, what do I always say about the VIX? Most of the time, it's not telling us anything. So if you're thinking it's telling you something significant every day, then you're probably over analyzing the VIX. But I always say that when it's moving in the same direction as the S&P, pay attention. And so we had the S&P moving higher and the VIX going higher. What does that tell me? Well, it tells me that traders were hedging despite the rally. Not in an aggressive way, because we would have seen a much bigger spike, a spike up above 20 if they were really aggressively hedging. But they were starting to hedge a little bit, buying those protective puts. Now, you can say, well, because what I would immediately say is, well, that tells me that they don't trust the rally, right? And why would you buy protection and buy stocks? Well, you would do it if you think you may be getting at the end of a rally. The rally's getting a little bit stretched, and you want to participate in it, but you also don't want to give it all back if it drops sharply. So you buy some protective puts and you buy some stock, and that would be that behavior as well. But I think it had a little bit more to do with the news this week. CPI was going to be coming out this morning, the Fed meeting tomorrow, and the market's now breaking out. What if the CPI report shows inflation increasing? The market could sell off pretty sharply on that. I think that spike up a little bit yesterday had more to do with just hedging ahead of the big market moving binary events. They could go either way off of whatever news comes out on these events, and I think that's a little bit of why the VIX was moving higher. I don't look at, in other words, I don't look at that as suggesting, oh, the VIX is telling us don't trust this rally. It's gonna fall apart tomorrow or soon. Now there could be a little bit of that. We already talked about how, if it breaks out a little bit right here and it's already stretched, it could pull back a little bit. But and that could move the VIX up a little bit. The VIX is so low. I mean, it could rally all the way up to 20, and 20 is the kind of the lower area of complacency. It could, the market pullback off of a move up to 20, the VIX moving up to 20 could be just a basic pullback, not even anything significant anyway. So it's real easy for it to spike up a little bit from here. Now, if it had a massive move up on a big drop in the market, yeah, you'd want to pay attention because that could probably tell you it's just something, a bigger sell-off is just getting started. But I think a lot of that, just that pretty big spike up, moving in the same direction as the S&P, had a lot to do with just the events this week. By the way, Fed meeting tomorrow. With the way the market's reacted to the CPI report today, I think it's assuming the Fed isn't going to do anything this meeting. I think that's kind of the consensus belief right now. And so I don't know if there will be. Now, you never know with those because it could, a lot of people, yeah, they might feel like there might not be a rate hike tomorrow, but it's what's the language during the press conference, all that kind of crap. And maybe there's something there that spooks the market a little bit, but anyway, now the VIX is still a little bit elevated. It did come right back down, so again, it might be just kind of the same. Some traders hedged a little bit ahead of that Fed meeting tomorrow, and then we'll see how the VIX kind of moves after that. But it is so low right here. Again, I still hold to the fact that it feels like that coiled spring. The market is not prepared for an unexpected bearish event to come out. And so if there's anything that comes out that the market isn't expecting, it could easily trigger a pretty big sell-off in that condition. That's another reason to be a little bit cautious jumping in right here and on this rally is like I said, the markets fall a lot faster than they rise, and we could be 2 weeks and the market's still moving higher and you're seeing some gains, and in one day you could wipe out 2 weeks of gains and then some. Getting a bearish news with the market unprepared for it as it is right now, and so that's definitely why you wouldn't want to be just jumping in aggressively. You're putting all your money back in. I mean, the whole point of being patient during the bear market was to make sure that you had money at the bottom to get in and start getting in early into the bull market to where you could participate in it. You don't want to just jump in all in and then have an event like that just to wipe you out, and then you're right back where you started, or what you just had happen to you, what you wanted to prevent, which was to get your account cut in half right at the right as a bull market is starting or could be starting, and then you spend half the bull market just making back what you lost in 2 days or 3 days or something like that. All right. Other things to look at, the chip stocks moving higher again today, but you got a little bit of a bearish candle. It's low. It's trading lower than where it opened. It gapped up at the open. Now it's trading lower than where it opened. Again, we've seen a few of these. We saw that right here, and it did lead to a drop, but it wasn't a major drop. I'm not suggesting that this means it's you're going to have a big drop, but the near term it could pull back tomorrow off of something like that. But overall, though, the trend in the chip stocks looks okay. I don't see any breakdown yet. This is going to be a key low right here, especially since we broke out higher today. If we drop below this low, especially if it drops sharply and drops below that low, that would be a significant move. But we'll keep an eye on that. Bitcoin's been sitting right at this, go to a 2-year chart here. It's right at this kind of key. It's right here. These highs right here. This is kind of the cup or the inverse head and shoulders kind of pattern that formed. We pulled back to it. You want this area to hold. You're bullish on Bitcoin. We talked about how, we've talked about this area for a while. I mean, if we zoom back in to that 6-month chart, I kind of pointed this area out right here. This is that same area. And we're right at it. If it starts to dip below that, that's not real good. I mean, these are the lows down here. It still could have a deeper pullback and still go higher, but this is kind of that area where, here's the move up. You're retracing about 50% of that move. If you start getting a little bit more than that, that probability of this being the bottom, starts to diminish. So we'll keep an eye on that to see if it starts to rally here soon. All right. So that's kind of the condition we're in. Definitely see some potential for a little bit more upside, but there's a lot of we're stretched. We can become a little bit more stretched, but we are recognizing we're stretched a little bit. It'll be interesting to see how we close today. Again, we're off the highs. Again, all that could mean is maybe. And there's so much build up to this week in the CPI and Fed meeting, because it's the only thing, earnings, we're in between earnings seasons, and there was really no news going on in the last week or so, nothing significant. And so the build up was everything's focused on these 2 days, and it could, and we already had a run up ahead of time. So you wonder if what we start seeing is the market already anticipated this, that the Fed isn't going to raise, or that the CPI report was going to be fine. And it already moved up in anticipation of that. And so you could have a sell the news type of event where, okay, the news actually comes out, but the market's already traded that news, where you get a little bit of a pullback. And this is where a lot of the amateur traders, they don't understand that the markets do that all the time. And so they see the headline news, oh, that's bullish. They're the ones just running in to buy, and usually the professionals are they're using that event to sell. And the benefit they have is, remember, they want to sell and take their profits. One of the problems when you want to sell big position sizes, you got millions of shares. If you start taking profits on that gain and you start selling heavily, what happens? Well, you're flooding the market with supply, right? What happens when you flood the market with supply? Prices go down. And so what happens is you start to drive the prices down on yourself. You're trying to get out and take your profits, but now you and I don't have this problem, because if Apple goes up $10 and we want to sell it, we can sell our 100 shares and take our $10 profit, no problem. But if you're trying to sell 2 million shares all at the same time, you're going to slam that price right. You're going to eliminate that $10 profit, because it's going to come right. You just flooded the market with supply. Price has to come down, and you wiped out your gain on yourself. Now, what helps, though, is if you've got new buyers coming in. And so a lot of times, and there's a trick that they used to use. I don't know, some of these tricks, I don't know if they still do them. And it was common back when I first started trading, but what would happen a lot of times is these big institutional traders, the big institutional traders and the analysts for these companies are in bed together. They work together. I'm not saying that they always are on the same side of things, that analysts won't downgrade a stock, but there are favors that are out there. And if there's a big institutional trader that has Apple stock, and he has a nice profit on it, and the stock's all the way up here, and he wants to sell and take his profit, but he needs buyers to keep that price up high enough. He'll call up his analyst friend and say, hey, you owe me this favor. Can you put out an upgrade on Apple with a price target of whatever higher than where it is right now? And so the analyst says, okay, I owe you this. So he puts out the alert that they're raising the target on Apple. All these amateur traders start piling in on that announcement, and that gives that big institutional traders the buyers he needs to keep the price up high as he gets out. And then what happens? As soon as he gets out, price comes crashing down. And what can happen, it can benefit the analyst too, because the buying might even push it up close to that target, and then it comes crashing back down. The analyst can claim victory saying, hey, it didn't quite get to my target, but it was pretty close. Or they can put that target up where it's not that much higher than where it is right now. So the news event could be big enough to attract new buyers, but not so far away that it couldn't get close to it on some additional buying. And then, so, that, I don't know how much that stuff happens. I'm sure it probably still happens in some form today because Wall Street is Wall Street. But that, that's what so that happens a lot when you see a run up ahead of the news event, and then the news event comes out the way the direction the stock was moving in before that news event. Just be aware that it could be that that the market has already traded the news. It's already anticipated the news, traded it, and then it'll sell on the news. It'll actually do the opposite when the news comes out. I don't know that that's happening here, and it could be that it waits till tomorrow to sell on the news to see what the Fed does. But you always have to be anticipate that when you're in this condition, when you've had a run up ahead of an anticipated news event and you're getting a little bit stretched or overbought. You have to wonder if there will be a sell on the news. And again, it could just mean all it does is pull the market back, correct it, and it takes off again. I'm not suggesting that this is going to trigger a sell on the news would trigger a panic sell-off or anything like that. All right. Let me go to a couple of stocks. I want to get to the portfolio to wrap things up because we did get a really big move on one of our positions that it happens from time to time, and you take the gift when it's given, and it was given. But under the muscle stocks, just a couple of stocks just to keep to look at. We'll have more on Thursday, if especially if the market can pull back a little bit. But I have this. Hold on just a second. All right, so I like this BLFS right here, biotech. And again, just a typical pattern that I look for. Have this decline, had to move up. It looks like it's moving up the right side of the bowl. Had a little bit of a pullback right here. And the nice thing about something like this is you could use if you want a tight stop, you could use a stop right below there. Or you could use a wider stop if you were looking at a much bigger move. We can back out a little bit and look at this. So it had a big drop right through here. Boy, that's a key area right here if we can get above that. But that would be a benefit too if you're looking at much longer term. Maybe you feel it bottomed out right here and it has potential to get back up here. You could put a stop down below here, widen your risk a little bit, or you could wait to see if it breaks out above here, be a little bit patient, and then you could put a stop probably below here. But I like that longer term pattern that seems to be forming there on that particular stock. I like this ICVX. Kind of same thing, little bull pattern right here. Correction. Let's back out and look at the bigger picture on that one too. Oh, wow. Look at that. That's a nice little bull. Got a couple of them right here, and then this one right here. And this bull is higher than the previous bull. Again, you could wait for it to break out above the top of the bull there, or you could just trade off of this correction. You could wait for it to break out of this range and then put a stop down below here. There's some ways you could kind of trade that. And then the last one was Lenar, Len. Where was that? Right here, right at a 90 strength rank. But it's been a nice little uptrend, and it had this little just kind of dip down, move back up, a smaller dip right there. Now you could wait for it to clearly break out of this range here, or this resistance area up here. You could put a stop down below here. Those are a few patterns that are pretty nice. All right. So the portfolio, a couple things that I did. First of all, the one that I got out of yesterday, and you can still get out of it today because it's not going to go anywhere really. But KDNY, Chinook Therapeutics. You know, we like the pattern down here as it was kind of forming that. It looked like it was moving up the right side of the bowl. Well, we got the gift yesterday where they are being bought out by Novartis. And so it moved right up here. Now, it's not going to, the reason why I got out of it yesterday is because it's not going to go any higher. Well, unless somebody comes in and says, well, we're willing to pay more. But that doesn't usually happen, particularly on this big of a move. And so what's going to happen now is this thing's going to flatline. And so that's what I'm saying. It's not really gone anywhere today. It's probably, it'll fluctuate a little bit in this range, but it's a tight range. You'll see this on the charts sometimes because it's hard to get it out of the scans. But you'll see charts like this where they make a big gap and then they flatline. And that, whenever you see that, that's a buyout. It means the company's been bought out. And in this case, you can be as greedy as you want, but it's probably not going to go any higher. You just take your profits on that. We made $5,000 on that move from our entry point where we got in. So we were up a little bit already, but we got that big gift right there. It went up $14. And so we'll take that. Now that happened. Now I've talked about this in the biotech sector. This happens all the time, but the opposite can happen too. Their drug doesn't get approved by the FDA. It could drop 50% of the value overnight. So, be ready if you're going to trade that sector to have both of these type of events happen from time to time. And it's definitely not fun on the opposite side when it gets cut in half and you never had a chance to get out. It just dropped half its value and you lost $5,000. You're only planning on losing, 700 or 800, and you lost 5,000 because it just gapped. Their drug didn't get approved or what have you. So anyway, that one was nice. It put us up very nicely. We're up to 142,000. The gold trade is still. Like I said, we may end up getting stopped out of that one. But see that when you make 5,000 in one trade, then it doesn't bother me too much to just hold this and wait until it gets stopped out. It's not going to be that much more of a loss from here to get stopped out. And who knows? Maybe it turns around and goes higher. That's definitely a possibility. Portfolio here. ADMA looks good. Now we made this trade based off of this looking like an ABC pattern right here. Almost got stopped out on this move right here. It did dip a little bit below, I think, our stop price, but it didn't close below it. That's something I usually look for, to stop out as a wait for a close below my stop price. And now you've rebounded pretty nicely these last couple of days. It might be that this is the ABC. and we'll see if this takes off. But that's working a little bit more in our favor now. And then SGML, it's trying to break out. It's off the highs of the day there, but it's trying to break out here. See if it can. I've liked that uptrend for a while. I think our stop is down below here somewhere, so we got some room on this one. Now I may look to add some on Thursday. I didn't really feel like adding too much today. I didn't see a whole lot that I loved today. A lot of them look stretched, and I want that get that little bit of a pullback. But I'll start adding. I'm not going to go all in yet, where we have all of our cash in. We still only have a small portion of our cash. I'll probably move towards, depending on the charts and the market behavior and what I see. And again, if we can get a pullback that looks corrective, that we have more confidence in the uptrend continuing, I may go to about 50% in as far as total cash in. That doesn't mean that that's all at risk. We'll have stops on those positions, but start to increase our position sizes a little bit based off of moving above. I told you I would do it. If we moved above that area and we're now in an area where it becomes less likely that we get the big drop and more likely the market can continue to move higher, you got to trade that. You got to trade what the trend is actually doing, what the market's actually doing. And it doesn't mean you still don't look out for warning signs. But if you get too locked into a bias, that's when in this case, being too locked into a bias wouldn't hurt us too much because we're mostly in cash, right? And it would just be an opportunity cost where you could have made some money getting in, but you kept waiting for this pullback that doesn't seem to be coming. But in some cases, if you're if you're overly bullish and you're locked into the bullish bias, you're all committed, you got all your capital committed, you're ignoring every bearish warning sign out there. That's where getting too locked into a directional bias could really hurt you. You might not see those. You might not be paying attention to those warning signs of that a bigger sell-off could be coming. All right, so that's. I did get out of I did have the hedge on the SARK. Remember, that was expecting a pullback. I held that into this morning because, we had the behavior on Friday that looked like it was bumping up against that resistance, showing a little bit of bearish reversal. But then, you just didn't know how the market would react to the CPI report. And because yesterday I'd already made $5,000 on KDNY, why not keep the hedge on overnight for that CPI report? But I took it off. I got out of this morning, took a little bit of a loss. I think it was a $150 loss on the SARK, which is fine. And if the market looks like it could have a bigger drop, I'll jump back into some of these, just trying to make a little bit on. Mostly you're trying to just make enough on the drop to offset what you might be losing on some of your bullish trades, your long positions. But that's how I use some of those inverse ETFs. You'll see me jump in and out with some of those from time to time. And I'll try to explain it when I use them for those that are new. All right. Real quickly here, I did want to go over or take a peek at those big mega cap tech stocks. I'd like to see, do these start taking off again, or do we start to see a divergence where these are selling off? And again, I want to see if they are indeed holding up the market. What I saw when I went through this before class was a little bit of a mixed. Some of them were looking still a little bit weak. NVIDIA is back up near its highs. That's not showing any bearish signs. Microsoft, a little bit of a bearish indecision candle. But again, not anything that's strongly bearish. Apple showing a little bit it's bumping up against its all-time high. I think it hit an all-time high yesterday. But it's showing a little bit of weakness today, but nothing that's showing the trends breaking down yet. AMD, a big bearish engulfing pattern today, so we'll see how that plays out. But Google didn't really participate in the recent rally much. That looks sluggish. So you got impulsive up, impulsive down, and then corrective as it's trying to rally back up, and then a bearish reversal candle. So that'll be interesting to see. This is showing some signs of maybe rolling over a little bit. But again, if 8 of the 10 are not showing strong weakness and 2 of the 10 are, is that a strong indication that everything's rolling over? No, you don't want to. I don't want to say the whole market is going to move based on what Google does. That's why I'm looking at a bunch of these here, seeing if we see some combined signals. A little bit of a bearish candle today on Amazon, near a new high right here, new recent high, but it seems to be showing a little bit of a reversal. See how that plays out over the next day or two. Like I said, I thought for sure on this bearish reversal, I think that was last Wednesday. I think I mentioned this on Thursday. You don't see weird. I mean, these were 4% drops in some of these stocks, and usually that's not, especially in the context of already having a big run up. That's usually the start of a pullback, as opposed to the middle of a move higher. And so we didn't, though. We rallied a little bit off of that, although the rally stayed within that candle. And it basically, we're still within the candle because we opened above it, but we're back in that range, that candle range from last Wednesday. So it's not overly bearish, but it's showing buying exhaustion. The buyers aren't jumping in right here, even though the market's breaking out a little bit. So that's something to keep an eye on. Tesla's Tesla, boy, it shook off some pretty strong bearish reversal candles. This one and this one. I wouldn't chase it here, but I'm not seeing strong sign. It could be a little bit of a spinning top candle by the end of the day, but I definitely wouldn't short it here, especially after I already took a shot at it back here, thinking for sure that thing was going to. Actually, it was back here. This gap up was that news that GM was going to use their charging network, which again, you couldn't have known that ahead of time unless you were an insider. But I think it's just continued to go higher. Netflix, not showing any weakness in Netflix. Meta, a little bit of a bearish candle today. The bottom line, though, is that none of these are showing strong reversals, but it's something I'm kind of keeping an eye on, watching, because, and again, these were the ones leading the market up. If they start to break down, that could be an early signal that maybe the market has a little bit of a bigger pullback or correction. All right, thanks everyone. Have a great week. We'll see you Thursday for the stock specific class. Bye everyone.